All right, welcome to the Explainer. Today, we're diving into the absolute roller coaster that is the 15-year history of Bitcoin. We're going to tune out the daily hype and look strictly at the hard data, tracing exactly how a niche internet experiment evolved into an asset that's literally shaking up global Wall Street. So to really get where Bitcoin came from, we gotta rewind. Think back to the ashes of the 2008 global financial crisis. Bank bailouts are making headlines everywhere. Public trust is pretty much at rock bottom. And out of all that chaos, one absolutely crucial question emerges. Could money actually work without a trusted middleman? We're gonna break this whole story down into four parts: origins, the rise, the falls, and finally, what comes next. Let's kick things off with part one, origins. Picture it, 2008. Big banks are failing, and people are furious. Right in the middle of this, an anonymous figure, or maybe a whole group of people, we still don't know, named Satoshi Nakamoto proposes a totally new system, one that didn't need a bank at all. In 2009, Nakamoto publishes the now famous Bitcoin white paper, and shortly after, the very first Bitcoin trade goes down. At the time, it was worth practically zero. It was really just a conceptual response to a broken financial system. Satoshi's whole pitch was actually pretty brilliant in its simplicity. The core promise was all about replacing the need for institutional trust with undeniable cryptographic proof. The ultimate goal? Let two willing people transact directly with each other, completely bypassing the banks and all the risks that come with them. But to actually make this work without a central bank acting as the referee, Nakamoto used something called a blockchain. Think of it as a massive, decentralized engine. It's designed to stop someone from fraudulently spending the same digital coin twice. So instead of a bank verifying the ledger behind closed doors, you have this vast network of computers verifying and timestamping every single transaction in public, making it practically impossible to fake the record. Okay, moving right along to part two, the rise. Driven by insane curiosity, a lot of speculation, and these built-in algorithmic supply cuts we call halvings, which is basically when the creation of new Bitcoin gets automatically chopped in half to create scarcity, the asset just went parabolic. We're talking a massive 8,000% price surge in 2011. Suddenly, the whole world realized this obscure computer code actually commanded real-world value. But man, it was not a smooth ride at all. Despite suffering these brutal crypto winters with devastating 80% drawdowns, where most people assumed the experiment was totally dead, Bitcoin showed this really unique resilience. It just kept bouncing back, consistently hitting new all-time highs within 2 to 3 years of a crash. And by 2018, this repeating cycle was starting to pull in some serious, sustained institutional money. Which brings us to part three, the falls. Because Bitcoin's history is heavily defined by these crazy euphoric booms that are almost inevitably followed by devastating institutional failures. Take the infamous Mt. Gox exchange in Tokyo back in 2014. At its peak, this one platform was handling over 70% of all global Bitcoin trades. But then, massive internal theft is revealed, trading is abruptly suspended, and boom, it ends in bankruptcy. Hundreds of thousands of user coins were just gone. It was a catastrophic real-world wake-up call about the dangers of trusting a central platform with your crypto. Fast forward a bit to November 2022, and we see history rhyme. The sudden liquidity failure of the FTX exchange sent another absolute shockwave across the market. Just like Mt. Gox, FTX was seen as an industry giant. Its overnight collapse proved that, even years later, the crypto ecosystem was still incredibly vulnerable to these massive exchange-level disasters. But here's what's actually wild when you look at the data from the FTX crash. On the exact day it went down, Bitcoin tanked over 11%. But the contagion? It was completely fenced into the crypto world. Traditional US equities barely flinched, and gold actually jumped almost 6%. Traditional finance just absorbed the shock without any systemic panic. And that leads us to part four, what comes next? Having survived all those brutal washouts, 2024 ushered in a profoundly new era. The US SEC officially approved spot Bitcoin ETFs, which basically bridged the gap between crypto and traditional Wall Street. Now, an exchange-traded fund, or ETF, just means that for the first time, everyday investors didn't need to mess around with securing digital wallets or remembering passphrases. They could just buy into Bitcoin directly through the familiar, regulated stock exchanges they were already using. What happened next is super interesting. Right after those ETFs got the green light, Bitcoin's correlation with the S&P 500 spiked sharply upward. As all this mainstream capital started flowing in, Wall Street institutions basically started trading Bitcoin less like some rogue currency and much more like a traditional high-risk tech stock. On the flip side, though, its correlation with gold, that basically stayed flat, which is a huge deal because it totally challenges that long-held popular narrative that Bitcoin is just digital gold. People expected it to act like a safe haven during a crisis, but post-ETF, the big money is clearly treating it quite differently than traditional gold. So now, the market is basically split between two completely opposite outlooks. In one corner, you've got the view that Bitcoin has finally arrived as a mature institutional asset, totally legitimized by regulated ETFs and corporate adoption. In the other corner, critics, like researchers over at Wharton, are throwing up red flags, arguing it's just a speculative bubble driven by FOMO, similar to the 2008 mortgage-backed securities crisis, because it still lacks real-world tangible backing. So, as we wrap up this explainer, I want to leave you with a question to chew on. When you weigh all these competing historical facts, the tech breakthroughs, the brutal crashes, the Wall Street adoption, what is this thing ultimately going to be? A safe haven? A high-risk tech bet? Or just a brand new way to transact? The data tells a really complex story, and honestly, the next chapter is still being written right now. Thanks so much for tuning in, and keep asking the right questions.